Hello guys, welcome to question and answer series. Today we'll talk about what is a trade. Trade is a voluntary exchange of goods, services, or both. It involves the transfer of goods or services from one person or entity to another, often in exchange of money. Economists refer to a system or network that allows trade as a market. So this is what Wikipedia says, but we're interested more in trading as an activity on the market, as speculating on the price. So in margin trading, we can call trade as a planned and executed event of purchasing or selling the asset or a contract to take an advantage of price movement. It consists of the direction, long or short, position size, entry and exit strategy. It should be based on traders' own defined strategy and trading style. So this is my definition. And let's see how the trade should be shaped. First of all, the direction. It should be based on general bias and your strategy. It will define if you want to go long, short, or just stay away by being neutral and just waiting for the market to unfold. And you can believe me or not, but I spent most of my time just waiting for the market to show me the way. Entry will be the price you want to execute a trade. You want to put your money on risk. Buy the support, sell the resistance, and don't enter between them. It's easy as it may look easy, but it is also based on your strategy. So entry will be like a first step to create, second step actually, to create a trade. Then in planning phase, where you will take profit. You just need to know how long you want to hold the trade. It can be a fixed take profit, like you select already an area which you will be taking your position out, or it will be a moving take profit based on your strategy with, let's say, moving averages. Remember that unrealized profit, something which people tend to show on Discord channel or in trading communities, it's not profit at all. When you book it and you have it in your wallet, that's the profit. If it's just only shown by the change in the value of your position, everything can be done with it and everything can happen to it. So it's not a profit. Stop loss. I refer to stop loss as a safety belt. Stop losses are meant not to be triggered. Remember, stop loss is only to save you from a flash crash, from the volatile price action against your position. Most of the time you will be able to exit your position manually, but if your stop loss is really like a safety belt. There is a saying, cut the losers, run the winners. It needs to be in place because you don't want to go too deep into the loss. You don't want to hold your position also too long. Rather take loss like a man and live with it. And it also give you time to seek for a new entry. Exit strategy is a general concept where you will be right or wrong based on the price movement and your indicators, your strategy. So it is like before you even place a position, you just need to know what you will do with it in the future. Because I see many people, and I did it in my past, that just enter the position without knowing what they want to do with it. And they just enter, let's say they have unrealized profit on a table and they didn't know where to take it, and it turns later that the winning position becomes a loser because they didn't have a plan. The last one will be position size. In my opinion, it should be just based on a risk taken, meaning that the amount of money you will lose by being wrong on the market should be no more than a certain percentage of your wallet. If you don't know how to do it, please watch my other videos. Also, you can use my free-to-use calculator available online for managing your position size based on the risk you're willing to take. The link is down below, so feel free to use it. And the visual example of a trade example, we had our entry here. This would be our stop loss, so it's placed like in the area which is unlikely to get triggered, and if it gets triggered, it would probably mean that I'm wrong about the direction. I was using, with this trade, I was using the 21 exponential moving average and 55 exponential moving average strategy, which means that I basically entered on a retest of the 21 exponential moving average, and I'm closing my trade only when the candle closes below the 55, which you see my exit was not fixed, my take profit was not fixed, and the output of the trade was based actually on one trigger, on the and it was my plan on the dildo closing below the 55 EMA. We had a trade direction long because we were in general bullish trend, and that's it. It is how the trade should be shaped. Of course, you can select the take profit like a fixed one and wait either for stop loss to get hit or the take profit. And also you can just use different strategy, but I just wanted to show you an example of a trade, how it should be structured. So let's talk at the end of this video actually about planning. I told that trade is a planned event, so before you pull the trigger, before you put the money on the risk, plan it carefully. Jumping the gun because you thought it will be okay, it's one of the best account reapers and killers. This is what I always do. I take my time before I even open my trading terminal. I even think about putting money at risk. I analyze the charts, I get a macro picture, I pick my bias and select buy and sell zones, and just wait for the chart to unfold, to show me the direction, to show me the opportunity. And I already have a plan how I will be entering, and if the opportunity is present, first I calculate everything like my position size, I seek where I will be wrong and I place my stop loss there. I select my strategy based on the market and just plan in general, and then I place a trade. I think before I act, because after you put your money on the risk, it is not the time to be thinking about if you're wrong or right. It's really because when you put the money on the risk, you will be in an emotional state of mind, meaning that you will be not thinking clearly, and any logic which you used to enter your trade will not matter to you. I guarantee you that. So only activity during the trade, when you are in a trade, is just managing, using your plan, your strategy. So it's like flying a plane on an autopilot. After you lift off and you switch on the autopilot, only thing you need to do is just manage it. Just check if it's right, if it's wrong, if everything is correct. And you have absolutely nothing else to do with it. So think before you act. That's my advice for it. And at the end, just remember, there is a saying, and this is a really big truth in it: bulls make money, bears make money, and pigs get slaughtered. So if you want to know more about the trading, and if you want to ask me more questions, please don't hesitate to visit my Discord. It's free for everyone. You can ask me questions there, which I will try to answer in the next videos. And for now, just take care and trade safe.